And welcome back. We are going to learn about some basic charting tools in section 3 of this course. It includes individual candlesticks and some patterns of candles. In addition to the candles, we will also learn how to analyze the moving averages. Candles and moving averages are the very basic tools which are used for technical analysis in charts. So let us start this course, the section on charting now. In this course of mastering stock trading, we are going to learn about basics of charting in this section. Charting is very essential to make a system for building wealth for beginners and busy professionals. By the end of this section, you will learn how to analyze the market sentiments basically by analyzing the candlesticks and the patterns of multiple candlesticks. Also, we will learn how to identify the strength of a trend in the market and the sustainability of the trend using the moving averages. First of all, let us understand why charting is important. Charting or making graphs and charts is important because we can actually use the data to tell us the story. It provides the visual clarity. Now, just see the raw data on the left hand side. Just by seeing the raw data, it is extremely difficult to see the trend. We cannot analyze the structure and also the characteristics of the prices or the volumes or any other data of the market without using the charts or graphs. So the charting provides the visual clarity that helps in decision making. Now, candlesticks are the most popular tools to represent the prices in a technical chart. In case of a candlestick, we can see two parts, wicks, which are at upper side of the body and also the lower side of the body. You can see the upper side wick from the top of the body and the lower side of the wick from the lower part of the body. The colors of the candle also suggest the pattern of the trading during the session. Candlesticks can be used for any session. It can be for seeing the pattern of the prices during a day or during a week or during the month or any other duration. Green candles in any chart generally are used to represent the prices increasing or when buyers are dominating the session. Red candles are used to represent the dominance of sellers and the price decrease. Now, what this body of the candle, which is the filled box, suggests is the opening and closing price for the session. For one day candle, you can see in a green candle dominated by the buyers, the green candle lower part of the body, this part, will show the opening price of the day and fluctuation of pricing below the opening price is the lower part of the wick. And in case of green candle, the upper part of the body suggests the closing price of the asset that day and also the extreme price movement beyond the closing price during the day or during the session. In case of a red candle, the prices fell down. That is why the open price is up and the lower price is down. And here the prices which are denoted by the wick are at both the sides of the body of the candle here. So what these wicks suggest, what these bodies suggest, we're going to study in detail in this section. These are very important concepts because the candle body and the wicks, they tell us a story about the market sentiment and also the battle between the buyers and the sellers. Buyers are generally called bulls and sellers are called bears. Let us understand the anatomy of a candlestick first of all. The body of the candle can be long body or a short body. When long body candles are observed, it means the prices moved significantly during the session. It can be dominance of the buyer or dominance of the seller, and the prices range are large during the session. In case of a short body candles, the prices during the session didn't change much, didn't move much. From wicks we can see other story. A long lower wick means buyers are successful in pushing the pricing up, and the body is at the top. It means the price actually is increasing and there is a chance of further increase in the price in the next session. Similarly, the long upper wick also shows extreme price movements and sellers pushing the price down from high, and that is why it's a bearish signal. It is called shooting star. We'll study these short wicks which are also there in some candles. Short wicks means extreme price movements were not there much and the buyers or the sellers were very determined and they had a strong conviction in one direction. So green short wick long body candle suggests bullish close, and the red long body short wick candle suggests strong bearish close. We will also study the top 10 most powerful candlestick patterns, which are spinning tops and shooting star, hammer, doji, bullish and bearish engulfing, evening star and morning star, three soldiers and three crows. Let us study about the candle patterns which show indecision in the market. It means neither the buyer nor the sellers are having any dominance during the session and the prices do not change much. Spinning tops have long wicks and near middle small bodies. They are at the consolidation phase of the stock and it signifies a pause in the trend, and traders need to wait for any confirmation in prices before taking any decision when they see the spinning tops. The extreme form of spinning top is doji. In doji, there is almost no body. It means the current trend is actually losing the momentum and there may be a reversal of the trend after this particular candle. There are some candles which represent bearish signs like evening star. It's a group of three candles, a green candle followed by a small candle of red, followed by a big candle of red color. Buyers were initially in control, but later on, the sellers took the control, pushed the prices down. Similarly, bearish engulfing, the red candle is enveloping the green candle almost completely. It means sellers are actually taking over the market and wiping out the previous gains. Shooting star is where buyers are pushing the pricing to new highs, but sellers aggressively sold, and then prices move towards the downside of the market for that particular session. It's a rejection of higher price, and the next candle may actually start a trend which is bearish in nature, means prices may decrease further. Bullish signs is a hammer. It means the sellers pushed the price drastically lower, but ultimately buyers took the control and they put the price further high and the price closed near the high. Similarly, bullish engulfing, which is the opposite of bearish engulfing, where a green candle envelops the red candle, showing a change in the trend. Now, bears are no more the dominant in the particular stock here, and the buyers are taking the control, so bulls may take control from here. Morning star, where the green candle is started forming after the red candle has lost its dominance, which you can see from this particular pattern of the candles. There is also again a very strong sign of either bullish or the bearish trend. Here you can see in 3 sessions, 3 candles are formed, which are green candles. So obviously they are up against each other, and it means buyers are in full control, and it's kind of a confirmation of a bullish trend. Similarly, if these are 3 downwards going candles of red color, it means sellers are in full control over the last 3 periods, and bearish trend confirmation is there. Let's see these candles in actual charts. Now, what do you see in this portion of the chart? You can see multiple hammers, which actually suggests that prices may go up. A bullish sign is there, and indeed prices went up after this. Similarly, you can see the 3 soldiers, green color, but immediately followed by the bearish engulf and a shooting star also. It shows possible reversal pattern, and we can see that reversal pattern has actually happened. The prices started falling down. Here you can see the opposite of the bearish engulf. There is a bullish engulf followed by full body long green candle, and that is why a bullish reversal is indicated by this candle here. And this is the candle with indecision, with only wicks, almost no body. And you can see after these candles, there is a stagnation in the price, and prices are not moving much. Apart from the candles, we also need to learn about the moving averages. So in terms of moving averages, there are 2 major types of moving averages which traders use. The first one is called the simple moving average. Averages are used to filter out the daily noise, and we can see the trend over the days. So when we take the moving average line, we can see a very good continuation, a very visible continuation of prices with a trend. In terms of simple moving average, it's just the sum of closing prices over a period, about number of periods we are considering. So sum of closing prices divided by the number of periods. For example, 10-day SMA, 10 days closing prices divided by 10. Exponential moving average is a smarter average because it has more weightage to the recent prices. So it is more sensitive to the recent changes and the new information, and it shifts quicker than the simple moving average. The logic of using EMA or exponential moving average is that in markets which move very fast, what happens recently, like yesterday, day before yesterday, is actually more relevant than what happened some days ago. So it reduces the lag. SMA reacts slowly and EMA reacts faster. Now, how are they used? If you see both SMA and EMA on a chart, you can see something like this. Now, SMA 9 days and EMA 9 days, both are 9 days lines here. But you can see the blue line, which is EMA, it acts faster. The price is going down here. And then at the same time, EMA is quickly going down, the blue line, but the SMA is holding. Similarly, in this place, the same thing happened. So EMA reacting quickly and provides early signals. So how to use EMA and SMA? Whenever we are interested to know about the long-term trends, which are also called institutional trends, these are 50-day or 200-day moving averages we use. So we use the simple moving average there. But when we want to use the averages for shorter term, like 9-day and 21-day, or 10 days or 20 days EMA, these are the short term. So we should actually use the EMA here, not the SMA. This is an example of use of a short-term EMA and a long-term SMA. The blue line is the EMA short-term 9 days and the black line is SMA 50-day. We will learn more about the use of moving averages in the technical analysis in future. What is important for us now is to study at least 20 charts daily from TradingView. So this is something which is useful for you. You can analyze the candles, size, color and patterns from the charts. You can see how the moving averages are behaving. You can try different types of moving averages over the chart and see a relationship between the prices and moving averages. One warning which is essential here is that candlestick patterns are actually not perfect. And moving averages may point something, but actual price action happened in some other direction. So why it is happening? Because moving averages and candlesticks are just the foundations. They provide you the alphabets to actually do the technical trading, but ultimately we cannot use them in isolation. We cannot use just the candlesticks or just the moving averages or even candlesticks and moving averages to make a decision. We have to use multiple indicators following the rule of convergence and look for multiple reasons to believe before taking any decision. So now you should go through multiple charts, learn about the types of candles you have learned, and see the different moving averages on those charts. You will get a good amount of learning and information when you do those activities. Thank you.